The market just threw us the biggest curveball of 2025, and most people have no idea what's really happening behind the scenes. The market earthquake yesterday has a lot of people worried, not because of the facts that stocks went down, but the fact that they did so on a day when they should have gone up. After a blockbuster earnings report from undoubtedly the most important company in the world. Now look, I am still optimistic, but I'm also seeing a set of conditions forming under the surface that deserve our full attention. We just wrapped up what I like to call the Super Bowl of earnings, and Nvidia did not just win. They lit up the entire scoreboard. I'm not going to drag you through every number line here, but this is what matters. Nvidia absolutely crushed earnings. Big sales, huge growth, record profits. And right on cue, the usual critics came out with the same old accusations. Even Michael Burry, who hasn't gotten it right since calling the '08 housing bubble, threw a jab at OpenAI for good measure. Now look, some of what Burry says has truth to it. The AI ecosystem is messy. Circular financing is real. I don't trust anything that comes out of CEO Sam Altman's mouth. But here's the key point. These companies are still generating monster earnings, and they're still spending aggressively to keep the AI boom alive. The challenge is this. The market is priced for perfection. So even a flawless Nvidia beat wasn't enough when expectations were already sky high. Yesterday, after gapping higher at the open, some investors took the opportunity to sell their shares. They decided to nail down profits, to get out while the getting's good. And up until now, we have not seen this. And so for the first time in months, I'm seeing a few developments that have me shifting from full throttle to eyes wide open. Now let's break down what hit the market yesterday. First, the latest jobs report came out. The U.S. added 119,000 jobs, which is better than expected. But unemployment ticked up to 4.4%, slightly above expectations and the highest since 2021. But the real number I'm watching, continuing jobless claims. They jumped to nearly 2 million, almost the highest since 2021. And this is the category that shows how many people are still unemployed longer. This is where stress really starts to show up. Now, look, these numbers are not catastrophic, but they are likely to rise once October's layoffs hit the data. But here's the part nobody's talking about. The Labor Department announced that the November jobs report will not be released until December 16th, 6 days after the next Fed meeting. And folks, the market hates uncertainty. What this means is the Fed will be walking into the most important meeting of the year with no labor data. They're flying blind. And when the Fed doesn't know, their default is simple. No cut. So unless something forces their hand before December the 10th, we should expect no change. And so for the first time in weeks, the market finally realized that rate cuts are not guaranteed. As if that wasn't enough, the Fed decided that yesterday was a perfect day to stir the pot. First, we heard from Governor Lisa Cook. She decided to remind everyone that valuations look stretched. Liquidity's thinning out. AI-driven trading models can both stabilize or destabilize markets, depending on how they move. Thanks, Lisa. That alone would have sparked some fear coming from a Fed governor, but then the Chicago Fed president steps up and made it worse. He basically said the economy's strong, but inflation progress is stalled. He is not comfortable front-loading any cuts, meaning cutting before the data absolutely confirms it. And the data situation, as he put it, is, quote, a mess. Now, he even admitted that missing data makes him more nervous about inflation. So in the middle of a down day, these clowns of the Fed come out and essentially say, we're uneasy, we're half blind, we're not cutting. So it's no surprise that a normal dip turned into a much broader sell-off. Now, let's talk about the big one here. What could cause an even bigger move? Every month, we get an options expiration, kind of a routine market reset. So the vast majority of stock options are monthly options. They expire the third Friday of that month. But today happens to be the largest November options expiration in history. We are looking at $3.1 trillion worth of contracts expiring. 1.7 trillion tied to the S&P index, 700 plus billion in single stock options, and the rest spread across ETFs and a few other indices. Now, why is this such a big deal? Well, because for an entire month, dealers, market makers, they hedge those options. And those hedges stabilize the market. So if everybody is loading up on call options, bet that Nvidia is going to go higher, they go buy up a bunch of Nvidia stock to hedge themselves. They'll sell any contract, any option you want to buy. And if everyone is right, they don't want to be sitting there with $1 billion loss on their hands. So everybody's betting long, they're buying up the stock. When those options expire, they then sell that stock. Same thing happens on the downside. Everybody's betting on it to go lower. They get short the stock, that exacerbates it. And then as the options expire, they buy back all those shares and lift it back. So it essentially dampens volatility. It smooths out the moves. But when trillions of dollars expire all at once, all those stabilizers disappear instantly. It's like taking the training wheels off a bike while it's still rolling downhill. So today could be a wild day. Fast moves, thin liquidity, big swings. If you're an active trader, a day trader, it's exactly what you've been looking for. If you're not, might be a good time to take a breath. Now, once the options sweep clears, we have one more domino set to fall, and that is the CTAs, the Commodity Trading Advisors. Now, CTAs are not a big chunk of the market. They're these funds that base generally purely on mathematical models. They're using futures contracts and options or commodities. They move a couple $100 billion based purely on price and momentum. They don't care about earnings. They don't care about GDP. They could give two you-know-whats that Nvidia beat earnings by a mile. They just follow formulas. And right now, after yesterday, these formulas are saying one thing: sell, 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 sell. Goldman expects more than $75 billion in forced CTA selling. Now, that's not so huge in terms of the big market, but the reason it matters is CTAs tend to amplify what the trend is already forming. When markets are climbing, they're on the bandwagon, riding the trend long. They're buying more on leverage. That pushes them even higher. But when volatility spikes, when momentum weakens and stocks begin to fall, they're forced mechanically to either pull out or often go short. Again, not because they're scared, not because they disagree with the data, but because their models demand it. And that selling, at least in the short term, can drag the market lower even when the fundamentals look strong. And consumers are really splitting apart. I mean, the gap between the haves and have-nots widens by the day. And we see it in the data. Higher income households are still spending strongly. Their spending is going up, while lower income households are quickly pulling back. And we see this in stocks. The mega caps are rising, and the low-end retail companies are actually falling. So the low-end consumer is unhealthy. The high-end consumer is booming. Good news is not moving markets. That's usually a sign that algorithms, not humans, are driving the tape. It's also a sign, often, of a near-term top. And look, that would make total sense. The NASDAQ is up 45% since April. It needs to consolidate, to absorb the sellers, get some of the leverage out of the market in order to remain healthy and continue the move higher. So where does this leave us? Well, it's kind of a week-by-week market right now. The story changes quickly. Flows shift even faster. But the good news is we've seen this pattern all year long. The market drops, everybody panics, then we grind right back up. A Santa rally is still absolutely on the table, as I pointed out in yesterday's video. But I also cannot ignore the macro picture is cooling. Cracks are forming quietly, slowly, small ones, but they're forming. But here's what keeps me bullish. Despite everything happening beneath the surface, one massive force is still powering this market higher. AI capex spending. Capex is Wall Street's fancy word for capital expenditures. It's the dollars they spend on chips and infrastructure and building. Now, the hyperscalers are still spending aggressively. They're still investing heavily in infrastructure. And earnings across the entire AI ecosystem continue to impress. As long as that engine is running, this market is not out of fuel, not even close. Folks, we've never seen anything like this. The closest thing to what we are experiencing today was the dot-com boom of the late 1990s. The market soared as internet stocks moved 5, 10 plus times higher. Microsoft, AOL, Cisco, those were the Nvidias and OpenAIs of the time, but there is one very crucial difference. Most of those stocks at that time had no real profits. They were nothing more than a story, a promise of big revenue in the future. But that is not the situation today. Nvidia reported third quarter revenue of $57 billion yesterday, up 62% year over year. It posted profits of $31.9 billion. That is net income. That is bottom line after all expenses are paid. And this kind of growth at this scale has never been seen before. And if we revisit the market of the late 90s, just look at what happened. Now, this is early 1999. The NASDAQ had doubled over the last 3 years, exactly where we stand today. Valuations were stretched. Everyone is calling for a crash, and we know it eventually did. But before that, the market doubled again. And like I said, that was without billions in profits, without record growth, and betting on a technology that moved at nowhere near the speed of AI. So how far can stocks rise from here? There is no telling. So I'm staying optimistic but cautious. This is a playable market, a profitable market, as long as you respect the landlines. Now make sure to subscribe so you don't miss what's coming next, and I'll see you in the next video.